Are US stocks heading for a punishing sell-off? Today we discuss JP Morgan and Goldman Sachs' thoughts on this matter and also some of their secret indicators to what they usually are looking for. We'll also be talking about global growth outlook. As it deteriorates, should we be concerned? And of course, whether we now have a market that has already packed in a Fed rate hike pause. No one believes Jerome Powell and what he has to say anymore. And of course, stocks, commodities and cryptos are acting accordingly. We'll also be talking about something that just happened over the last couple of hours that was a big deal. And it's got to do with central bank liquidity. Yes, we have some updates on that and it's very interesting. Stay tuned. Let's get into it together. Well, welcome back everyone to the Daily Show where we talk about markets around the world. As per usual, we're covering the macro, the leading indicators, and of course the hottest charts, and they're all coming your way today. If it's your first time here, welcome, subscribe, smash that like button if you enjoy the content. I'm sure you will, and let's get into it. Let's begin here with Microsoft, Apple, Google, and Amazon. Of course, all of the big tech stocks were doing the best over the last 24 hours. And some of the other markets weren't doing so well. Notably, banks were down pretty hard on the session. We'll talk about what that means a little bit later on. We've also got the survey reports coming in from retail traders and investors. What's happening in the retail world? Well, advisors and retail traders are still ultra bullish. We've now had 3 weeks of ultra bullish reads, and we've just started to see a potential little bit of a turn or crack in the market's rally. We also know that 27.8% of people have now gone into the bearish side on this report, and it's amazing how fast this will switch should we actually see a significant sell-off. So by popular demand, we've bought it back. Smart money versus dumb money. What are the charts showing us? Usually we use this more as a contrarian indicator, and of course we're talking about retail traders buying heavily here and so-called labeled smart money not buying anymore. In fact, they've been net sellers according to Goldman Sachs over the last couple of days. Now, of course, this is just an indicator. What we've used it in the past to really detail is tops of markets when we get to these extreme zones. And of course, that's how we like to use it. So it's time to look at this now over the next coming weeks. Bull-bear spread has also been very interesting here. You can see that we've got now a quite high read here in the amount of bulls versus bears. We finally crossed the zero threshold for the first time in a couple of years. And realistically, these are the reads that make us think maybe we need to be putting a pause here and having some concerns in this current market. What else is going on? Well, of course, JP Morgan's squeeze sentiment indicator, as we mentioned only at the beginning of this week, showed us that we're at extreme highs here. We started to see a sell in NASDAQ, in S&P, in Russell 2000 and other markets around the world. And that is consistent when we hit the 99th percentile, which is something that we literally just reached as of last Friday when we saw a little bit of a turn and a potential stop loss hunt. So if it's your first time here or you haven't joined us over on Twitter, definitely consider doing so. We post a chart here about equity risk premiums. And this is something that Mike Wilson from Morgan Stanley has been mentioning really all of the late end of 2022 into 23. So far, he's been wrong, but of course, he was very correct in 2021 when at the end of that year, he said, you've got to get out of the market. It's going to go down. So what is equity risk premium? Well, basically, it's showing us the difference between risk-free rate, therefore something like a treasury bond, and cash or something like that, and the stock market. And this is starting to hit near 20-year lows. Now, has it been lower before? Yes. During the 1990s into the tech boom, it actually got epically bad. But it can show us that maybe it is not the best time to be in the markets. And this is a fairly prominent big indicator that's coming in right now. If earnings go bad in Q3, which is traditionally one of the weakest times, even in pre-election years, it may be a problem. Here's another big note here coming out from JP Morgan and, of course, Goldman Sachs. JP Morgan just said that they've seen $4.4 billion in equities within the past week, which is remarkable 2 standard deviations beyond the 12 months average. Who's buying? It's retail traders. Now, this is unusual volume, and it is certainly not the hedge fund traders because Goldman Sachs has stated that 9 of the last 10 days, hedge funds have been net equity sellers. So they're selling into our buy. Is smart money versus dumb money really coming true at this point? Well, of course, these are just stats and something that we're looking for. Speaking of stats, we talked about June 19th to June 27th. That's this week. Has it been down so far? The answer is yes, so far it has. Will it close down? I guess it may. And it lives up to that 418 stat that we see after the OPEX. Interestingly, we get much more negativity after the September OPEX, which is the third week options expiration. So that'll be an interesting one as well. But June 27th, to July 23, do remember the stats are actually still bullish in favor. Does that mean go out and buy this market right now? I've said it for a few weeks now and even maybe a month and a half. Single stocks and sectors are still probably my preferred areas because what we're actually seeing here is potentially the end of this final rally component and maybe a very good point where swing traders actually will come in. I think over the next couple of trade days, we're going to find out whether this market is going to go towards mean reversion, the 20 weekly moving average. So what about call volumes on tech? This is an older chart now taken from 2 weeks ago, but you can see that we'd just be even higher now. We got new records on calls. We've got records for buying by retail traders, and we know that everyone's taking leverage, which is usually a recipe for, let's call it short-term disasters generally on these markets. From an investment standpoint, is it cheap to buy in these markets? We're sitting at about 18.6 times forward PE. It's not super expensive, nor is it super cheap. I like 16.8. Do you tend to get that many times over an investment career? Absolutely. And it goes down to one of the reasons that I like to buy when others are maybe fearful when it comes to this as an investment. Remember, investing and trading is a very different thing. So from an investment perspective, it's probably not the cheapest time for the main stocks out there being the tech ones. What about the Treasury yield curve? Well, a lot of people keep going on about recession. We've talked about this before. Recessions never get called until the yield curve tends to go back above zero. So basically it uninverts. We are not looking at that right now. In fact, what's actually happening here is it continues to steepen and deepen. And the longer that we get this Treasury yield curve in this inversion, it's actually showing you that there's more sickness in the market, but it can take longer to play out. Now, traditionally, it's been between 12 and 18 months that you usually see the recession getting called. I think 12 months was March to March. So we're starting to get to a point now where if we don't see a slowdown in the economy, it's actually becoming an unusual, not unrealistically unusual time for recession not to be called. Now, what do we also look for? Usually one of the last signs 6 months before a recession is called, we see jobs start to weaken. Has that happened in the US? Absolutely not. But with central bankers around the world maybe pulling liquidity, which we'll see very soon on a chart, plus 50 basis points from the UK and probably some more from the Fed now, it could be getting a little bit nasty. Now, we know that when we talk about seasonal patterns, some of the weakest periods of the time of the year are generally the back end of July, August, September into October. During pre-election years, that also stands true. So with a extreme greed reading such as 80, we do need to also be cautious on the macro side right now. Let's jump into the wonderful world of options at the moment, which has been where most of you are probably trading, and that's been picking up really squeezed stocks. They've been trading on the weekly and, of course, 0DTE and indices. Where was the unusual trades over the last 24 hours? Tesla continues to be a large volume trade from a lot of big players. Amazon was really strong, 1.91 times 90-day volume average. We saw 4.3% on that in terms of its rally. And you've got a couple of other ones coming through here as well with some unusual holdings. PayPal continues to be relatively strong. Disney's fallen off, which is one we talked about, and Intel's gotten a massive smashing. It's probably taken off about 50% of what we've really been running here on that particular stock. We might look at that later on. What about the SPY versus Q calls or puts? Did we see anything interesting? Not really. They were mostly all just for the day and the session. You can see a pretty big amount of calls and a few puts here, but the dates themselves were all mostly for this week. Now, when we move over to individual stocks, you'll notice the biggest call of the day was Amazon, probably no surprise. And then we go through some other interesting ones. We've seen this Ribbon come up a few times now in recent trades. PBR's also there. Amazon getting some love, and same with Tesla. Not too much to note, I think, from the options world. We will do a special weekend edition on it this week, though, so make sure to subscribe for that as we go into whether we've had any good, unusual flow over the last week that can show us something that might be an inkling of a big put or something like that in the markets. Over the last 24 hours, we've seen movements into technology stocks, but also two of the better defensive sectors were doing the best. XLV, XLP, obviously utilities was not there, but two of the three were better. When we look at a 5-day average, interesting here as well, some of the things that we always had hoped to see if we were going to get a sell. Healthcare, staples, utilities, some of the best 5-day averages. That's the type of rotation that we've been looking for in this market. And of course, it's important. Now, for crypto people are getting wild again. They're calling out the 50,000, 80,000 crypto numbers. Is it cheap? Is it expensive? Is it time to celebrate yet? Well, maybe not yet, but certainly you've had a decent little breakout here. And this is a combo that many people have used in the past. There's also BTC ETH that we might look at as well on the weekend, especially if we do end up getting a run in Bitcoin. But as a ratio, Bitcoin is not really rallying just yet. Now, it took around last time, I think, because we started rallying about April. We started then about October. So it took a little while. Now, if you consider that we started really rallying this market around December, let's claim, then we're probably on around the same period. So actually from the bottom and from the breakouts, Bitcoin does make some sense. We won't stick on that until we get into stocks, but I do think that we need to break past 30,500 plus on the weekly close. And if that happens, yeah, it could be an explosive period because, of course, this would be a flag at that point. You'd get confirmation of breakout and then you'd be able to get your legs in. And, of course, that might be exciting for some crypto, especially Bitcoin travelers out there. The other thing is if Bitcoin goes, usually it goes first, then the rest of the coins follow afterwards. So it'll be an interesting story out there. Maybe it's coming back online. This is our combo of major big tech stocks and AI that have done very well recently. As you can see, they are very far away from what we call mean reversion, and that's usually where you need to be the most cautious. It's not the furthest it's ever been, but it's certainly one of them. The biggest one, I think, percentage-wise, was over here in August of 2020, and we can all see how that played out. It came down pretty hard, and in fact, the sell-off as a percentage at that point was from the top to that point around 19.27%. Funnily enough, if we came from here and we went from the high to where it is, that's about 21%. So not unheard of style sell-offs in these markets. And of course, I feel like it's possible that that does happen, but we need to see some technical signs first. The volatility of volatility, or the VVIX, that was down over the last 24 hours. And the VIX still is just plummeting. It has no volatility in it. It's being suppressed still. And we can, that's why we're using VVIX and a few other like VIX1Ds and a few other codes at the moment. Speaking of VIX, or at least the Black Swan indicator here, and it is getting crushed. That is a good sign if you're a bear in the markets. This is the type of thing we were looking for, and I would give that a thumb up at this point in terms of what's been happening. Because, of course, the skew, with all the big sell-offs, we've usually seen a crash come first. Now, does that mean that you're going to get some massive sell-off? No, it doesn't mean 20%. It doesn't tell you the size, but it's the right type of sign. What about put-call ratio? That's looking really good as well. Still people buying calls. Each day, the market is still absorbing more calls than puts. And of course, that's getting rid of a lot of the puts that have been sitting in the system for so long. As we know, it got one-sided. It was put everywhere. Every time the market even dropped 0.5%, everyone was just loading puts. That reflex has now been taken out of the market a little bit. It opens up the flexibility of it going potentially both ways. Let's move over to copper. What's copper doing here? Well, you can see that copper came into the supply and it has sold off again. That's a good sign. We're looking now for a new low to be formed on copper. And now when I say it's a good sign, it just kind of goes with those other symptoms that are happening here in the markets. Copper, if it does break through this high, is on a new run. And I would say that's got to do with Chinese stocks and more to do with stimulation that might come through that market. And speaking of Chinese stocks, I just want to bring up CQQQ here. Now, I've been talking a little bit about this in our private community as well. This is coming down to a very interesting technical zone. Now, I do expect them to stimulate the economy correctly and do that over time. I very much doubt they won't, but you need to remember as well, they don't tend to protect any one stock. Also, they tend to overtake a lot of stocks over there, so there are risks. But interesting point here. It is basically a giant inverse head and shoulders, as you can see on this chart. This is the CQQQ. There are a whole bunch of different funds, but go and have a look through them. That might be interesting. Now, where is this getting even bigger? Let's get into the US market now. And whoa, okay, let's see if that thing ends up being the real read. We've got new data coming in from central bank liquidity flows, and it is negative, guys. That is a very interesting sign. We might need to look a little bit more into that on the weekend video. We know the disparity between the two are massive. This is something we've been looking for a while. And yeah, that's a big drop off. Now, is that a catalyst? No, but it's another signal that if that keeps dropping off and we keep moving away further from it, it is a very unhealthy market. If you're a believer that the Federal Reserve is holding this market up, which they have been and they are, then suddenly things have switched during Jerome Powell's speech this week and the back-end systems have changed. Let's move over to the US dollar. Pretty strong, good little trade here in the last 24 hours off the bottom. Like to see that through 102.38, but at this point it's finding some buys and it's actually done in theory what we kind of wanted it to do. Come back to our interesting bull zone, rally hopefully up now through this area, then drop a bit off and then basically pick up. Now that's consistent with gold also getting sold off. We had a suspicion this would happen in our last video. I'm sure many of you are pretty happy with this one. It's gone back into 1910 to 1900. Now, will it find buyers here? We don't know yet, but this is certainly what we would call a demand zone and gold may start to stabilize in here. Obviously, if dollar goes super bullish, gold might even go back through into this zone because, of course, we know that there was a lot of skipping of price during that huge rally in gold. Gold doesn't like new high rates as long as we don't have stagflation, so I think it's starting to price some of that in. Natural gas has been brought to my attention again. We talked about this being a base a while ago. It has been accelerating the last couple of days of trade. A few people doing well here that have been long-term believers. The only problem with gas is always the roll contracts, but that's a good looking base and it does look like gas has put its low in for now. What about bonds? Let's go over to the bond market as we dive deeper into individual stocks and indices. Yep, that's interesting. Couple of days down here for junk bonds. That's the type of thing that you want to see as well. We've talked about the correlation with junk bonds and the market, and it's had 4 days of sell. A sell into a buy on the S&P in the last 24 hours. Interesting point. The bonds, if they keep selling off and the market keeps flatlining, not a good sign for it. SoFi hit our take profit number 2, or at least our technical level there, $10 a few weeks ago or a week ago. It's sold off from there. And you can see some of these stocks that were running hot have started to weaken off. Another one that I think we need to look at is probably PLTR and see how that ends up trading through. So it's actually gotten above that zone, and you can see here a big sell-off here on the weekly. We suspected this might happen. All of these huge move stocks will now more than likely revert back, lose a fair bit of what they've put on, and at least that's like the kind of way that technicals usually play off on those blow-off style tops. Let's move over to PayPal. This one's been activating for us recently. It's still continuing to do okay considering where the market's at. And yeah, it's held its own, I think, in this recent little bit of a sell-off. One that hasn't held its own has been Intel. Let's quickly put a watermark on here so you guys can see it. So Intel's dropped back down. Could this be like a little bit of a buy area? I would say something in this structure, so maybe even a bit more selling. But yeah, Intel, look, we're looking for it for 38. It had an amazing run since we talked about it down in here. And I'm sure some of you would have been taking some profit, but 2 brutal days of sell-off on that stock for sure. As we mentioned, utilities, staples, healthcare, they're all starting to turn. Pretty decent levels for them to turn on and make sense for them to be there. Now we'll move over to Tesla. What's going on this stock? Well, Tesla has been running really hot. It looks like it might close as something like a long leg doji, which is indecision. We've theorized that maybe Tesla can go towards the final level of 300, but it did get a sell-off. Now, if we go to the 2-hour chart, which we'll do now, have we seen a change of trend? The answer is no, not on a big time frame. We need to take this level out here, and it would probably be worthwhile marking something like this on your chart just so you're aware of where possibly the market might be turning around. A big pullback here, you'd want to see selling on this over, I would say, the next 24 hours over the Friday trade. Let's move over to semis. They hit the peaking highs a little while ago. Again, semis have pretty noticeable swing trade levels, and at this stage, they're just kind of hovering around this area. Is it a clear sell? Probably not yet. Not for swing traders anyway, but yeah, it's certainly at the highs and it's consolidating where you would expect it to. One market that's getting sold off heavily was US 2000. Now, we thought that this might happen where it might break through this very strong block, and it looks like there's more to go on the US 2000. The next level really is around 1800, so that's another 36 style points off this index, and it's dropping off while the rest of the market actually rallied. So the Russell sold off while the bigger tech stocks held up. You can see here the NASDAQ went up, quite far away from its moving average, as we know. And then the NASDAQ rallied super hard off this nice demand zone. It broke through this one and it rallied off this. Now, I think that somewhere in this area, which is where it is right now, we have a pretty strong supply. Be very interesting to see whether this rally dump can stick. And I wouldn't be surprised at all on the next day of trade for us to go higher, potentially into here, see a sell, and then if that did happen, take the low. And this is a very interesting chart. The NASDAQ should be watched. It's kind of come up to where if sellers are going to sell it, they're going to try it around that area, and they need to get it underneath 14.7. If they do, next stop, probably looking at about 14.2. So I'm sure some people are interested in seeing that happen. Now, why could that happen? Well, a lot of it has to do with the SPX going outside of things like the weekly Bollinger as well. Over the last 24 hours, if you were a buyer of both the US 500 and NASDAQ, though, I would have said that was a great level. Even in our private community, we were talking about it. This zone here, very hard to get through initially. Quite weak, I would say, from the S&P in comparison to the NASDAQ in the way that it rallied. But I think a lot of that has to do with the buy the dip style reflex. Who's buying this market right now? Well, according to what Goldman is saying, what JP is saying, and what everyone else is supposedly telling us, it would be us, the retail traders. Is that true? I guess we'll find out very, very soon. And of course, we're looking for the S&P to get below 43.37 to really show us that it means business and possible mean reversion. Next stop would be in the 42 kind of 80s to 42.60s. And then, of course, if we go back into that huge zone that we've been sitting on, that's right where that 20 moving average sits. And we'll talk about that in the weekend video. If you're not aware, but most of the big news is now out for this week, but we still have a bunch coming out from the Eurozone. And of course, we also have Flash Services PMI for the US at 9:45 on Friday. Make sure to always have your calendar ready. And if you're interested, make sure to subscribe to this channel. Smash that like button. We'll see you in the next one. Thanks very much for sticking with us. I know we didn't get a video out on Thursday. I posted on Twitter, so make sure to follow us there. I'll always alert you guys to it, and our Discord. But yeah, we're back. Don't worry. We'll be producing every day of the week. It was just once off for that one. Thanks so much for the support, guys. See you in the next one.